Welcome, ladies and gentlemen, to our conference. Is it possible to reprivatize the U.S. financial system? This conference is jointly sponsored by AEI and the Professional Risk Managers International Association. I'm Alex Pollock, a resident fellow at AEI, and I have the honor of moderating our discussion today.
We would make explicit in these institutions what is supported and what isn't. For example, the credit risk in mortgage-backed securities would be supported by this federal wrap. Absolutely nothing else would be. So there would be no support for the debt. We would limit the types of products that would be supported. It would only be 30-year or similar 15-year fixed-rate type mortgages, perhaps an ARM product, a very limited set of products. It would not be an open-ended implicit guarantee for the institution if they decided, like Fannie and Freddie did, to extend out into pay option ARMs or Alt-A product or some of the other loans that are giving them so much trouble.
There is the risk that government guarantees in other countries are going to beget the demand for government guarantees for our institutions, and we're already well down that particular road. And I think there is a risk in the end that implicit guarantees may win in the short run, and to the extent that they do, we may be opening the door to other financial crises down the road.
Then the congressional response, and to me this is key. It is fundamental to the federalist concept that in the U.S. the initial assumption of government was that all commerce would be regulated by the states and not by the federal government. And as you look at the panoply of federal government agencies, each one of them, I think without exception, certainly in the financial institutions area, were the result of and the reaction to a crisis, real or perceived. Every single one of them. So the other implicit assumption is that at the federal level, you do not regulate until it's obvious that you need to.
The more aggressively we continue with the stance of kicking the can down the road and failing to force the recognition of losses throughout the system, the larger the losses become and the harder it becomes to extract ourselves. It's interesting that we're talking about how to reprivatize, and yet not one of us has said that you really can't reprivatize until you have an honest discussion about how losses are allocated. And neither the Dodd bill that we saw, the 1,100 pages, nor the Barney Frank discussion draft explicitly point out that in this country we do have general rules on capital and capital structures, and the equity holder is supposed to get wiped out first, and theoretically the taxpayer is supposed to take the hit after the rest of the capital structure is wiped out. And we have not seen those losses apportioned throughout the system, nor are we actually seeing any of the legislative offerings suggest that that happen or be explicitly stated. So I think that once you're down that path, once you're starting to talk about a systemic risk regulator, it becomes harder and harder and harder to see anything but miles and miles and years of government entrenchment in the industry. The second we start talking about systemic risk regulator, we're really saying that the government is going to remain more deeply involved in the industry because we need to have the bomb squad standing around the bomb rather than dismantling it. And unfortunately, can we? Yes. Do I see any will to pull back and reprivatize? No. We're not actually recognizing any of the losses. We're probably only about halfway through the losses in the market economy. And that's not even considering the fact that we've got significant, larger losses ahead in the real economy.
I have a real problem with systemic risk as a concept. Usually when you get a definition of systemic risk, it runs something like this. Systemic risk is a problem caused by systemically important institutions. I was always told that you shouldn't use the word that you're defining as part of the definition, but somehow that seems to be characteristic of how we define systemic risk. And so until we come up with a better definition, I don't think we should create a regulatory body to deal with it. I would argue that we should have a simple goal, and that is to make the failure or closure of an individual institution an individual isolated event. And that's what was terribly wrong with the TARP. It tried to hide the bad apples among the good. It was the same thing that Paul Volcker did when Continental Illinois failed. First thing he did was to get all the major money institutions to lend money to Continental Illinois. That's not the way you create independence of failure. So that should be the objective.
Since in the crisis, finance becomes political finance, or even more political finance, in answering the question, how do we get out of the nationalization of the financial services system, at least in very large part, as politics looms very large.
I think there are two things that we're trying to, that monetary policy tries to achieve. Number one of it is maximum performance of the economy over time, and cost of capital has an impact on that, and guarding against inflation. So you have to do two of them simultaneously. And I think in terms of the limited opportunity that monetary policy has to impact the economy, and it's more limited, I think, than is widely recognized. I think at this particular point in time, where there's a tremendous, where the economy is so soft, and I think that the Fed has the right policy of maintaining a low interest rate, and I think that Ben Bernanke is conscious of the fact that that was one of the fundamental errors of the post-Depression era, when there was a concern about cutting off inflation too early, that I think caused a real contraction of the economy. So I think that to the extent that you'll see monetary policy impact on that, you will see a low inflation environment until they start to sense inflationary pressures that perhaps need to take a change in that approach. 50 years from now, people in power today, people in positions of authority, want to be recognized as the next FDR, not the next Herbert Hoover. Just to put it real bluntly, Herbert Hoover, one of the most misunderstood policymakers in history, I think. But there will be an activist response. Now we can. If you ask me what's going to happen between now and Election Day, two things will happen. There will be a bill, and we will have a new agency, and if and all of our responses to previous financial economic crises have ended up with that sort of a scenario.